Okay, so good morning. Most of you, I think, are on the West Coast. For those in the East Coast, good afternoon. My name is Avijit Chatterjee. Really delighted that you folks could join us today. Thanks to Rohan for helping set this up. So a little bit about myself. I came to this country back in 1989. And so, it's generations ago. I have been in the tech industry more as a computer scientist, studied a PhD in USC in Southern California, Los Angeles. And one winter, I think just maybe not even in 2000 December, but maybe a couple of years later, 2002 December, I that's when the internet was also taking off. And so the idea of browsers, idea of content out in the internet was really becoming very prevalent. I came across this site, which I will share with you, called stockcharts.com. And I came across this site where it had a kind of an education section there called Chartschool, and that's where that's where my learned knowledge on technical analysis came from. So having done that back in 2002, and I spent, I would say, maybe 1 week. It was over winter holiday. 1 week I spent through it, and I read it like a book, chapter by chapter. And I have to tell you that the experience was eye-opening, eye-popping, because I did not expect that the market has so much of order, has so much of method to the madness in how it works. And just like as you can see here, you can see that Rohan beautifully created this website, but each of these zigzag patterns that you see and the individual bars in them, those are what we call as candles. That's just one technique of drawing charts called candlestick. And as I started understanding what a candlestick meant, how to read a candlestick chart, I never believed in astrology. And it's something that I've seen my uncle when I grew up, that he would take a palm and he would just see all the patterns in the palm and be able to tell about every relative of ours what their future would be. And many folks would come to him, and he was a banker. He was also a numbers guy. Loved math, loved numbers. But there was some aspect to that, what was in a palm, that made him read the palm so well. And to me, I never understood what the magic was in his brain, but he obviously had some triggers that could spot those patterns on the palm and detect and make some forms of analysis with it. Similar kind of thing clicked on my mind, that it's just amazing how you can take any company, any index, any instrument, financial instrument out there that can be plotted out in a chart, draw it, and you can actually spot patterns. And those patterns actually have some, whether you call it predictive power, whether you call it some form of kind of direction, kind of a predicting sense, there is some magic to it. And this has been what, almost 22 years since then. I have been actively using this self-learned knowledge in actively using in looking at charts. And as you will see through this journey today, that there is tremendous method to the madness, and there is tremendous repetitive nature of how these things happen. So with that, let's start off with, so this, by the way, is a very new site. We call it Charts Are Fun. Rohan and I created this. If you go down, the mission is very straightforward. It's educating investors to use charts for their personal investment decisions. One key disclaimer is, we're not investment advisors, so don't expect us to give you any investment advice. This is primarily an education to share how to spot patterns in charts. And then, of course, you make your own investment decisions based on these insights or other aspects of fundamental analysis, which is looking at the price of the stock, its earnings, its cash flow, its profitability, profit margins. All those play a role in your investment decision. And of course, you should always take advice from an investment advisor if that's where you want to guide him or her to have you guide in your decisions. But our mission is to really educate investors and educate them about making guided decisions, and share a little bit about how we make our decisions. I've been trying to put out blogs. I would love your comments and feedback if these blogs seem to be too technical or too jargony. My goal is to make it simpler to read, simpler to understand. But each of these are over the last week, as we know, a lot has happened. Key is the AI euphoria kind of had an extreme movement with NVIDIA's earnings and then the reactions to it. But leading up to NVIDIA's earnings, of course, was Palo Alto Networks. So it was a turn or tale of two cities or tale of 2 days, I would say. So the Palo Alto Network news hit the newswire on Tuesday, and Wednesday was basically a bloodbath. And interesting enough, you'll notice me cover that in the aspect of Godfather of AI, which is not my term. Dan Ives, from Wedbush, which is an analyst in Wall Street, calls Jensen Huang as the Godfather of AI and the company itself. No question, from what they do and what their business contributions are in the field of AI, company is absolutely doing great. So they sell off ahead of earnings, and that was exactly on Wednesday. But I can walk you through some of this, but you can also read. But once you see the basics of what I cover today, I think these blogs will start making sense, and then you can go start reading them and kind of, feel free to email me. I'll happily share my email or WhatsApp me, and I'll try to answer questions. But the idea again is in that day, Wednesday, when Palo Alto Networks just absolutely sold off over 120 points or whatever, I think on the previous day, it probably was $120 higher, and then it kind of tanked significantly. And NVIDIA took a big beating. So did SMCI, which is Supermicro, which is one of the systems makers, the servers that actually power the internet and power the compute out there in the data centers with GPUs in them. So while all that was happening, there were actually some aspects in the stock market, if you can start reading the tea leaves and see what was going on, that told us that there was actually a good chance while the retail investors were panicking and selling, the reverse was going on. The smart money was actually accumulating and getting ready to play it the other way. And that's pretty much what happened. I wouldn't say there's no guarantees in the market. I wouldn't say that every time you spot a pattern that it will play out in that direction, but often it guides you and gives you good insights on in where things are headed. So you'll see there's a blog about SMCI, a blog about Godfather AI NVIDIA. There is some aspect about, this is a broader notion of how to use breadth indicators, and I explain what breadth means to overall look at the market. The market has come up a lot since October lows. As you look through that, what does it mean to look at the next few months or the next few weeks? So anyway, so that's kind of a link to the blogs, but let's get started with the basic Bible of where I learned all my analysis. Now, I'm not promoting anything here. I'm just sharing. And my analysis skills have all come through stockcharts.com. It's a free website if you really want to look up stuff. I think Chartschool is even free. You can see school.stockcharts.com. But if you want to do a more granular analysis with more data options, with more settings and so on, there are membership options in there. I personally subscribe to what they call as the Pro membership. It's about $40 a month. I tend to renew my membership around the Cyber Monday. That's when the best deals come. So if you renew for the year, they give you 3 or 4 months free. So that's when I tend to go in. I renew it for a couple of years every time. And I find this site incredibly valuable. So, and there are, as you can see from the sites, there's charts and tools, different tools and techniques, articles. There's active amount of blogging that goes on that site. That's really worth looking at. All the technicians and fundamental folks publish articles there. There's a video. It's kind of linked with YouTube. So anything and they also have an app on the phone. So you can either look at all those videos recorded on Stock Charts TV, or you can watch it on YouTube. And then this is where the Bible is. This is where I learned. And if you look at it, it starts off with a table of contents, just like any book has an overview section. And then the chapters are just the basics of chart analysis, the various indicators and overlays, market indicators, market analysis, glossary. So it's a read that to me is fairly intuitive. It's not, you don't need to learn calculus. You don't need to know very sophisticated physics, math, or chemistry to understand this. It's English-like read, but the key is it is visual. The main skill set that's involved in this whole idea of charts and reading charts is you could have a visual inclination to looking at stuff. But beyond that, and some basics of what the charts say and how to read them, and then you can really follow and apply it. Of course, over time, you can pick up more and more of this skill. But if you look at this and you look at some of the sections in there, you'll notice there's short audio clips to listen to as well. But key is, as you go down each of these patterns, there are actually, say, Bollinger Bands. You click on it, you will actually see examples. So taking Microsoft, right, from 2021, it explains what Bollinger Band means in the context of a stock. So it kind of explains that with a picture, and then the math is also there. So if you are quantitative in nature and you want to write some algos, you want to write some quick codes to test out stuff, you can, the data is openly available, by the way. The data on stocks, you can go to Yahoo Finance, they have it there. I think there are other, in the exchanges like the NASDAQ, NYC, I think they make a CBOE, they make their data available as well, openly. So, and then if you're a stock charts member, you can get the data from there as well. And then you can calculate these formulas, and you can, using simple Python or whatever language you want, you could basically calculate and do some of this yourself if you want to do quantitative analysis. But the idea is that it's all very visual. They will actually show you tables of data, and they will walk you through the calculations. So it makes it very intuitive and easy to understand. So that's kind of the precursor to where the Bible is of reading and understanding, and where I read most of my stuff. So now coming into a very basic understanding of a stock chart and what it means. So let's take a very common ETF. ETF is an exchange traded fund. It's also what we call in today's world as passive investing. So if you think about, you hear this term often, active versus passive investing. Active investing is where you, doing your own analysis, whether it's fundamental or technical, pick a stock or pick a group of stocks, and then you invest in them, right? You could diversify by across industries, diversify by market cap. There are different techniques of diversification, but you could create a portfolio and you could pick your individual stocks. And the goal is to beat the index, right? So you could do it in a way that the stock, your group of stocks, your basket of stocks in your portfolio, at say a year-over-year comparison, so you look at its portfolio value in January and you look at it December 31st. Say your portfolio gained 15% and the market only went up 5%. So then, yeah, you beat the market and you put an amazing portfolio together. I would say on average, most investors in today's world, given the liquidity, the options, and how you can do things through ETFs, and this was again a newer generation idea to what used to be called mutual funds. So call it our parents' generation and so on. Mutual funds used to be the way they would invest, and that's what the financial industry would provide as a product to make investments on. The biggest difference between a mutual fund and an ETF, in all purposes, they are a group of stocks. A mutual fund is a group of stocks, an ETF is a group of stocks, is that a mutual fund, you can only invest at the end of the day's price. So there is no intraday, like there's no day trading that you can do on a mutual fund. So it's got a NAV, which is the net asset value. It effectively then plots as a stock index. And it changes every day, right? Because based on how the individual components within the mutual fund traded within the day, the mutual fund can go up and down every day. But all you can do with a mutual fund really is put some money, and then we got to wait for the end of the day's NAV value to see whatever the gain was, and then that's the gain that you would get, or that's the loss that you would have. ETF, similar idea. It's managed by a money manager like a mutual fund is. It's got a group of stocks in it that they adjust off and on. But the key is it trades intraday actively with a ticker symbol that minute by minute. It's got volume trading, it's got money movement in and out. And you can do day trading, you can do swing trading, you can do any kinds of active trading with an ETF. And gods of investment, whether it was I think John Bogle, then Vanguard, those are the gods of ETF creators. They kind of came up with the ideas of ETFs. So there are many thematic ETFs, there are many ETFs that are based on sectors and so on. But an index ETF, the most common ones is SPY for S&P 500. NASDAQ 100, which is the top 100 stock in the NASDAQ index, is QQQ. Also, it's called as an index, it's called NDX, but as an ETF, it's called QQQ. And for the small caps, is Russell 2000 is the index, but the ETF for that is IWM. So anyway, so let's look at this QQQ chart. And here I'm just so that you understand how this site works, stockcharts.com, is on the top panel, you see I'm hovering the mouse over it, is what we call it the relative strength index. That's a measurement, as you can see from the range, goes between 30. Well, 30 and 70 are the markers, but it really goes from 0 to 100. But 30 and below is when you say that the corresponding, whether it's a stock or a bond or whatever you're looking at, that financial instrument is oversold. So relative strength-wise, when the RSI value is below 30, you say it's oversold. And then when it crosses 70, you say it's overbought. And in a similar way, another pattern that is plotted out here, which is an indicator of the market momentum. So both the RSI and the PPO are market momentums. And the way you set them is in the indicator section here, you pick what and if you click on it, there's so many options here. You can see, about 30, 40 different indicators. But these are the most common ones you'll see in many charts in YouTube or anyone else sharing. And I actually commonly use these as the indicators that I follow. RSI, this parameters, is a notion of giving it some input on how to calculate. So RSI stands for Relative Strength Index, and typically 14 is a default value, and it tends to work quite well to give you the relative strength indication of that particular stock. Relative strength in many ways is computing a ratio of your average gains to the average losses. So if I take, in this case, and it's a moving concept, so over a moving period of 14, and I keep moving the window from the first 14 periods, and the reason you call it a period and not a day is you can define how do you plot the chart, right? Right here, if you notice period, I can do daily, I can do weekly, I can do monthly. So, and then at lower granularities, I can do, let me go down and show you. You can go all the way to 1 minute. So you can see 1 minute. So if you are a very, as a day trader looking at individual movements, you can go and do a 1 minute, 1 to 5. You will not see that in the free option because that's again how they want to, of course, have subscribers in to pay for the more granular features. But because I have the pro account, all these are available to me as settings that I can play with. But the idea is that you can do an RSI on a monthly chart where every candle, and this is what we call as a candle, is plotted out as 1 month of trading as the interval. Or you could do, in this case, daily. So each candle, in this case, is 1 day of trade. Now, there is a very nice feature they've added called Inspect. So I can click on Inspect, and I can hover the mouse over top. So now it's telling me that on 2nd of February, when the market opened that day, QQQ opened, that's the O, at $423.80. The high for that day was at $430.24. The low was at 422. The close was at 429. V is the volume. And in this case, Y just happens to be the Y-axis. It's just, based on where I am. If you notice, if I move the mouse, based on where I am, because if I'm trying to spot a value, I can move the Y down to that level. And so I'm at about 426 right now. And the reason the Y value is there is, say I want to find the tail of this candle here, right? So if I want to find the tail, you can see that there's a horizontal line at the Y-axis. So as it moves and it overlaps right at the tail, it tells me that, it was at 425. The other way to read it is I can always go to that candle and it will tell me the low of the day was 425. So either way you can corroborate. But the idea is every box that you see along the, as it moves up along the x-axis, this is time. Every interval is a day of trading. So 25th Jan, 26th, and then you jump to 29th. Why? Because you have a weekend, right? 27, 28 was Saturday, Sunday. And then again, 29, 30, 31, 1, 2. Then again, 3/4 is a weekend, and so on. That's how the time interval comes. Every box is the candle. And there are ways to read a candle. When you have a candle that's colored in red, that means that particular day, the market was negative to the previous day. And when you have a candle that's white, that means that particular day, the market was above the previous day. So when you have a gain, or an upward move, you will have a white candle. When you have a downward move or a decline, you will have a red candle. Now, how do you spot some of these typical patterns inside the candle? One is, if you notice, there's the wick of the candle. The wick is that line that goes to the dead center of the candle. That wick is effectively the range for that particular day. So in this case, if I would inspect again and I hover over this candle, the range that day was between high of 430, low of 422. So it was an 8-buck range on QQQ that particular day. Now, if you have a body, right, the body in this case, as you can see that it's hollow, as in there's no shade inside. A hollow shaded body means that the upper end of the candle, which is the close, and the lower, so the body represents the open and the close. That's where the body comes from. And the wick shows the intraday range, the min of the day and the max of the day. That's where the wick part comes from. So in this particular day, as you can see, the high was 430, and then it pulled back. It didn't close at the high. If it closed at the high, then the body would have stretched all the way to the high, which was in this particular day. On 29th Jan, you notice that the candle did go all the way to the top. So it closed very close to the high of the day, which is near 428, which is a very bullish sign. When you see, and so these candles and how they print and how they look at, actually, if you start reading them, they start giving you some indication about the bull versus the bear, bullish versus the bearish nature of that days of trading. This candle, when you have a dark red candle that looks like the way it is, that is actually a very bearish looking candle. Why is it bearish? Because look, the market opened at 434, and throughout the day, it probably sold off to the point where it closed at the lows of the day. That means if I look at the day's trading on that day, it kind of started off at the highs and ended at the lows. That means they have been selling pressure throughout the day. However, when I look at a day like this, that's a bullish day, just the picture, the mirror opposite of this bearish day. So 16th February is a bearish day, and 29th January is a bullish day. Why bullish day? Because it opened at the lows, and through the day it kept trading higher and closed at the highs. So when you look at hollow candles and you see a ton of hollow candles, that's overall a bullish trend, a bullish movement. And when you start seeing a lot of red candles, that's an indication of a bearish trend or a bearish movement. Now, what happened in QQQ over this time duration? So you can look at the time duration right here. Right now, I'm looking at 20 days. I can click here and I can pick whatever time duration I want. And granularity is there for me to pick year, month, and day. This is the period, whether it's daily, weekly, monthly. And then there are the types. I prefer candlestick, but there are at least 10, 12 other types of charting. OHLC bars, and it again is something that you can read about, and you can decide which one you like better. By default, the most prevalently used the chart pattern that people use is candlestick. Some people may prefer to use solid lines, dashed lines, dot, area, histogram, and so on. The other key thing to read in here is a huge indicator. So when you hear people say that, what's the price? By far, the biggest indicator of any stock or any index is its price action. So what does this chart tell me if I say in terms of price action? Well, price action in this case is, if I had to draw, like, most of you here are technical, and you know that if you have a scatter plot, you can draw a regression line, or you can draw kind of a trend line. In this case, the trend line, if I had to draw imaginary, is kind of trending up. You can see that from the left to the right, it's kind of heading in an upward direction. So it's been an upward trending line. And in fact, the way you look at that is that these closing values of every candle is the end of the box, right? So in this case, it first went up for a couple of days, then it came down, then it went up again. And so this is a trend where I would say maybe slight down, then again up, slight down for 2 days, then a nice upward trend from 31st Jan to 9th February, where you can see that it kept going, closing higher and higher and higher, till the point that on $439 on 12 Feb, it kind of hit an intermediate top, and then it dropped. It dropped to 425 the next day, 13th Feb, which I think was the day of the CPI. Whenever those kinds of economic data comes or earnings comes for individual stocks, you can have market moving events. Then from there, it started going higher again from 425 to 434, then another drop to 421, and then now it started going higher. So in this case, it's literally a set of trends where you go up, come down, go up, come down, go up, come down, and so on. And this blog that I just wrote is something worth looking at. This was written yesterday, is that what goes up eventually comes down. And it is hinting at a point that we feel that there is possibility that there is a market decline coming. And part of this is the nature of the market. It never goes up in a straight line. It always has that up and down movement. And the key is to look at the tea leaves, look at things that kind of are indicators of what are the likely outcomes in terms of an up or a down. It's very, very hard because the market is impossible to tame or time, but it is a guide. It gives you some indications of being able to look at directions and trends. So that's kind of the basics of, so there's a panel on the top called the Relative Strength Index. This is the price panel. Another key thing I forgot to mention is these histograms, these bar charts that you see, represents volume. So when you have red shaded bar, that means that was a red day. That means that was a day when the market was lower than the previous day. And when you have a dark black shaded bar, that means it was an up day. So that day the market was higher. So notice one phenomena in here. We are in the raging trends ever, but if you look at the red bars tend to be, in this case, bigger in size than the black bars. At least see, in this, while this was going up, you can see that the black bars were not as high till the point when it sold off. The red bar was very, very high. So, and also, how many red candles do I have in a time period and how many white candles do I have? This is a QQQ, but if you look at NVIDIA, you'll see a very different trend in how it has its movements. And you can see that in NVIDIA's case, there was a steady, strong upward trending move from 600 to all the way up to 746. Then it was flat in this particular region from 746 to 700, 696. It was kind of flat range kind of movement. And then there was a big drop from the 744 to the 662. This is the drop that was triggered on Palo Alto Networks earnings on Tuesday. So Wednesday was a big market sell-off. And that's when NVIDIA from 744 in a couple of days came down to, so 744 was the close on, close, not to the close, it was the high of that day. It was before the long weekend, the previous Friday. And then the market opened on 20th, the Tuesday. It already opened with NVIDIA coming down, so the downward trend started. And then it went all the way down to 662 on that day, on the 21st. And then earnings came, and we all know what happened. It jumped all the way from here to close to near 780 plus. And then yesterday, when it touched 830 or something, which you can see 823, and then it closed actually a lot lower from the high. Now, this candle, while you have a red shaded candle when it was a down day, you can have a black shaded candle when it's an up day, but the reason it's shaded and not hollow is because NVIDIA opened at a higher value and closed at a lower from the high. As in, it opened at 807, but it closed at below 807, as in it closed at 788. So when your close is below the open, you will have it shaded. When the close is above the open, you will have it hollow. So notice, so let's go now to kind of much like take a step back and look at the much bigger picture of S&P 500. This by far has 100-year plus history. And when you look at the longer term trends, you can start looking at the bigger picture of what has happened. I am incredibly impressed with one of the technicians I follow quite actively. His name is Tom Bowley. Tom Bowley is actually one of the Stock Charts active contributing members. So if you go to stockcharts.com and you look at their blogs and you look at contributions, he by far contributes a lot in there. There are many others in there as well. David Keller, for example. But Tom Bowley's analysis is something that clicks to me, and I am actually a subscriber of his service called earningsbeats.com. And he came up, and you can actually Google it up and YouTube, and you'll find many of his videos explaining this pattern. The pattern is what we call as secular trends in the market. Secular trends in the market is, if you look at, so there's cyclical and secular. Secular by its definition is a longer duration, and cyclical is a smaller, like a shorter duration. So if I look at a 100-year chart of S&P 500, and going back, as you can see, back to the 1925, remember we all heard about the Great Depression around the 30s. This is where the Great Depression happened. From S&P 31 came down to $4, right? So that was a literal collapse of, like from 31 coming down to 4 was almost an 85% plus collapse of the market at that time. So if I look at that entire time period and every bar here, so as I said, the period you choose, and if you have the pro membership, you can decide what period you want. Period you choose, you can be yearly, monthly. So in this case, every candle that you draw is for that year. So in this case, basically I have 100 such candles drawn out here for the 100-year time period that I'm looking at. But notice something very interesting that goes on in this 100-year time cycle. There are time periods for, in this case, where you are in a range-bound range. As in S&P has been in between the 30 to the 4 over, in this case, 1930s to close to 1950. That's a secular bear market. As in a secular bear market, you have kind of a flat market. Yes, there are ups and downs, but overall the market over the time period, from the beginning of the time period, then the time period hasn't gone anywhere. It has kind of stayed range bound. So that was one secular bear time period. Then we started a big bull run. So from 13 here, it went all the way up to 120 plus, right? That was the bull run that happened over 20-year period from 1950 to 1970. Then started another 10 to 15 year typically is when the bear runs happen, is another secular bear market from 1970 to 1980. It was again range bound. And also the pattern on the RSI is another key thing to observe. When you're in a secular bull market, like in this case from the 1950s to the 20-year run that we had, RSI, and this is a weekly, not a weekly, but a yearly chart. Every candle here is a year, stays very, very strong in an overbought range above 70. And you can see this whole entire duration RSI stayed above 70. Then as soon as the bear market kicks in, you get a drop of the RSI back towards the 50 line. From the 50 line is the center of the RSI. Then it starts climbing again. And over the next bull run that started, it stayed again above 70 for a long duration, the entire duration of that bull run. Then we had the .com secular bear market. That lasted for 10 to 12 years from 2000 to 2012. And the reason you call an end to the secular bull market is when you're broken out of range. Notice how the high at the .com in 2000 was 1553 in S&P. And in 2007, before the financial collapse happened, you hit very close to that high at 1576. And then the low that we know during the 2008 collapse was at exactly 666. So this market stayed in that 666 to the 1576 as the range for that 10 to 12 year duration. And during that secular bear market is when RSI on that yearly chart will dip back to 50, but eventually reclaim and climb back above 70 when the next secular bull market starts. So what pattern do we see from here? A pattern that we do see is one, RSI stays extremely strong during the secular bull market phase, trades above 70 and continues to stay there. When a bear market comes, RSI dips to 50 and kind of stays in between 70 and 50 to the point it comes and reclaims 70 and goes higher is when the bull market starts again. And the similar pattern on the other direction is what we call in the PPO, which is the percent price oscillator. It's similar to the idea of a MACD. It looks at two moving averages, in this case, the 12 period, as in the 12-year moving average, and the next time period is the 26-year moving average. And basically how these two moving averages converge, they get closer to each other and then diverge, they kind of separate out from each other. And the 9 in this case is using a 9-period average of this gap between the 12 and 26 to smoothen it out. So the red line that you see here, the red curve, is that moving average convergence divergence between the two periods, the 12 and 26, and 9 is the smoothened out line that kind of spans it across the red. Now the key is the histogram that you see here stays above 0 or it goes below 0. When it stays above 0, that means that the black line is above the red line. When the histogram goes negative below the 0 line, and it's beautiful how these things look like a nice bell-shaped curve, right? So you can see that it goes to the peak, comes back down, dips below the 0, forms another bell shape, goes up, forms another bell shape, and so on. And then the key thing is during the bear markets, right? This is the bear market. The PPO dips below the 0 line and stays in that. During the bull market climb, it stays above that. During the bear market climb, again, it dips below. Now we are in the bull market climb. Key is, this is to give you the bigger picture that while there are many out there, and if you can Google up in YouTube, you will say the skies are falling, S&P can go back to 1200 again, S&P can have a crash and everything else. Don't forget the bigger picture is we are in that bullish trend, and these bullish trends by far are 20 years in duration. You can see this was for 20 years from 1950 all the way to 1970. This started from 1980 to 2000, and we just started the other bull run 12 years ago in 2012. So this has legs till up to 2032. Take a step back and say, well, in the decade that we are in, we just saw the sizzle with OpenAI, with how AI has completely transformed the world around us, right? AI, of course, has been around for, since the 1950s, ever since Alan Turing, came up with Turing machine and coined Samuelson, all the gods of AI basically came up with the definitions and the core benefits. But the true, and then we've had AI with even our, these talking about technologies out, recognizing photos, recognizing talking to your the devices in the home, Google Home, and so on, with speech recognition kind of AI. But the true generative AI and the way AI has taken off in the last couple of years is just the beginning. And in the next 8 years, you can only expect more and more of this innovation. One is AI, the electric vehicle is the other one. So you'll see a big revolution continue all into a combined ecosystem, quantum. There's a lot of very, very cool stuff that's going to happen in the next several space. That's going to happen in the next several years. That means that this secular market has legs. So you should feel quite confident that in the notion of investing over the long duration, at least for the next year in 2024 till the next 8 years, that's our 20-year bull run. This market could have legs, and after that, maybe we could have a 10-year period where there could be a consolidation phase. But that's kind of the bigger picture that Tom Bowley has plotted out. And the more I look at the picture and the more I look at how the patterns pan out, it looks more and more now. Nothing can be, there's no guarantees to the market. Nothing can be said, but an indicator that you would look at this long-term chart is if for some reason, say, we got that, by the way, right? We did get a big pullback, and look at how in the big picture, those pullbacks that we get seem like nothing, right? So look at what happened in this 2020. You see that red candle, right? Now that was in 2021, the recent bear market that we got. And this one here is the COVID collapse that we got. But in the big picture, even though you got the COVID and this recent 2021, the SPAC kind of a collapse, it didn't cross below the 70 and started declining like you saw in the bear market here and this bear market here. As long as RSI continues to stay strong, PPO continues to stay strong above the center line, above the 0, this bull trend continues. And looking at this picture, I would say that just keep monitoring this. And as long as this stays positive in the above the 0 and this stays above 70, this bull run has legs. And I think it will continue over the next 8 years like it has here in the past for the 20-year duration. Now comes the idea of drawing channels or drawing trend lines. And you'll see this in every technical analysis. People will often take any time period, any chart, and they'll draw trend lines to it. In many cases, this is, while there's science part to it, it's visual in nature. Some of it is, especially when you draw trend lines, there is a little bit of art, there's a little bit of your perspective and how and where you draw trend lines. There's no hard and fast way of what the trend line that you would draw in. But the basic idea of trend lines is you draw the line to the tops and you draw a line to the bottoms. There are different theories, different patterns, and different ways to draw it. In this case, what I've done is a simplistic idea. I've taken the low from 1930, right? That's right around 4.4. And I've tried to draw a line, this blue line, joining the bottoms across from 1930 all the way to up to now. And you notice that only during the secular bear phase is when the pullback comes to the bottom of the trend line. Otherwise, when you have the bull market, so 1980 to 2000, the candles steadily move from the bottom of the trend line to the top of the trend line. Then from 2000 to 2013 or 12, when the financial collapse came, first the dot-com and the financial collapse, that's when again it pulled from the top of the trend line to the bottom of the trend line. So here is a touch of the bottom of the trend line. Here is a touch of the bottom of the trend line. Both are at the ends of that secular bear market. After that, we've been on a steady climb. And you notice that though we've got, the COVID collapse in this particular case, right? You notice that it really, in fact, the COVID collapse was that, let's not confuse. This red bar is not the COVID collapse. This is the COVID collapse. For that, and because this is a yearly chart, the end of the year on the COVID, while we had a intra-year dip to test that long-term moving averages, and by the way, moving average is another thing I didn't talk about. The curves that you see, in this case, the red curve, and then the curve above the blue color, are moving averages. Moving averages is basically you take the closing values over that period, whether it's over 50 periods or 20 over the 20 periods, and you divide it, right? So get the moving value, and the window keeps moving. So your 50 period average, right now is at, in this case, at 1285, and the 20 period is at 2237. And that's where these lines are at. But the key is, when you notice that during the bear market, when you have the secular bear markets, it does go below the 20 period, and it goes the other extreme to touch the bottom of the trend line. And then once it takes it up, during the secular bull market, it continues to hug along the 20. And even though we did get a pullback during the COVID year, that's the 2020 right here, we ended up positive for the year. So intra-year in March, we collapsed, but remember by the end of the year, there was a ton of liquidity that the Federal Reserve put in. Across the board, every country's put liquidity, and the market came back and actually closed higher for that year. That's why you see I have a hollow black candle, or a white candle in this case, not black, as in colored black, but white in nature, is because it was a bullish year. By the end of the year, it closed higher than the previous year. And only year that we did get a pullback, so this is, we are right in 2024, this is in 2022. And that's the most recent cyclical bear market that we had. So in the secular trends, which is the long duration, we do have cyclical moves where the market will pull back and then go up, pull back, and those are shorter in duration. The cyclical bear markets may last for a year and a half to two, and then you may have a couple of years of bull market and back down, back up. That's how in a secular trend, you will have several cyclical bear and bull markets. So in here, notice that we are right now, we did just very, very close to and above the trend line in 2021. That we know was, again, the year of the SPACs. There was tremendous speculation going on. Then we pulled back in 22. Now we are back again higher in 23 and 24, and we're headed back towards the top of the trend line. So overall, when people say that it makes sense to put your money in stocks and not like doubt a movement of like the thesis that keeping stocks over the long run actually pays off. And actually there is proven data that if you take such a long duration, on average, you have a 9 to 10% movement of an S&P 500 over this long duration. So effectively, you can see that it's a bottom left to the top right kind of a movement, and the secular trend continues, as in the market moves higher over time. Of course, you will get the periods when it'll be range bound, and during the range bound movements, you may make a decision that during that time, would you continue to be in stocks, or would you just have other kinds of instruments out there that you would consider when those secular bear markets happen. But right now, in the next 8 years remaining, because it's a typical 20-year duration, we started around, say, 2012. We are 12 years into it, another 8 years to go. So now let's look at what happened in the market in the last 1 year. This is where I am taking all the various instruments out there, even throwing in Bitcoin. And Bitcoin in this case is this one right here on the top. and that's drawn in the purple color. So I have the Dow Jones Industrial, which we know that very recent addition to that was Amazon, but there are 30 stocks in that index. So that's the Dow Jones Industrial in red. Then I have in blue the S&P 500. Then I have the small cap Russell 2000. Then I have the Nasdaq 100 in magenta. Then I have in light blue gold, which many people really look at and are, especially now, the gold bugs, the people who love gold, have been super excited that gold is in a major trend break situation, can cross 2000, and it would be a great instrument to invest in. And then you have dollar as a currency, because we live in this country. It does make a lot of sense for us to see how does the currency behave, how has it performed overall. So now currency is always relative. You have to take a currency and compare it to a basket of currencies. So in this case, it is actually an ETF for the currency called UUP, and that ETF takes the dollar to a basket of currencies. And so this is in black to see how the dollar has behaved. And this is a chart called PERS chart, a performance chart. It's one of the indications here. If you look at stock charts on the top and you look at it, you'll see there's a PERS chart. So if you click that, then you can put a set of symbols. In this case, I've picked, because these are all ETFs for the respective instruments, I've used the ETF. So instead of putting DJI, the real index, I called it Diamond, DIA. That's the ETF for Dow Jones. SPY for S&P 500, IWM for small caps, QQQ for NASDAQ, GLD for gold, UUP for the dollar. I wanted to look at treasuries, bonds, knowing that we've had very interesting interest rate movements and a lot of volatility. A good way to look at, if you have to invest in bonds as an ETF, TLT is a kind of a longer term treasury, more from a 20 plus year treasury kind of an ETF called TLT. And then I have plotted the Bitcoin. I could have put a Bitcoin ETF like a GBTC, but I decided just to use the actual Bitcoin itself, BTC USD $sign. That's the ticker for Bitcoin in stock charts. Then I wanted to look at commodities, because commodities are very cyclical, they go ups and down. So I wanted to see overall, while this is gold, but what is overall commodities doing? And then finally, knowing that we come from an emerging country, India, you could have plotted India here as well, but I'm just plotting the broader emerging market ETF called EEM. So I've taken all of this, I've plotted this out, and in here you can pick and choose what time period you want to compare them against. So starting off at 0 and what the movements are, you can see that I put 250 days to cover 1 year, because there are 20 trading days in a month roughly. So in 12 months, you're roughly 250 trading days, right? So in the 250 trading days, that is over the last 1 year, from late February of 23 to February 24, the biggest mover you can notice is Bitcoin, right? It's gone up 110%. So it is more than doubled, right, in this 1 year. The next biggest movement, so this is a relative comparison, right? The next biggest movement, as you can imagine, is QQQ. And no doubt about it, like half of it, it hasn't gone up 100, like doubled, but it has gone up 50%, right, in that 1 year. And that you can imagine, as we've heard often, this is also market cap weighted index. So because you have the big stocks like Apple, like Microsoft, together, that's why the Magnificent Seven idea came from. You take those big cap stocks or the mega cap stocks and you take their contribution to the QQQ, they have over, say, 30% or plus of the QQQ just by those top 5 or 6 or 7 stocks. And hence, if they have been performing really well, the overall index has performed really well as well. So that's no wonder NASDAQ, because of the big movements in Microsoft and Amazon, and they're all at 52-week, close to 52-week highs. The index here has gone up, and in fact now Nvidia is the number 3, between Microsoft number 1, Apple number 2, and Nvidia is number 3 in market cap. And then you have the next best index, and you can hover over it. It's S&P 500. It's at 30%. Then after that is the Dow Jones Industrial. Dow Jones Industrial, actually, if you notice, relatively was quite. So notice what's interesting is right from the beginning, right? Bitcoin took off, right? From the early 2023, you can see that Bitcoin took off. It has been leading across the board. At one point, it was closer to NASDAQ. The magenta is NASDAQ and Bitcoin is purple. So during the June to the August timeframe, when we had overall market kind of, over the summer of last year, Bitcoin and NASDAQ were about the same kind of percent gain. And then Nasdaq took a dip. That's the magenta, while Bitcoin stayed flat. And then is when late October 2023 onwards, Bitcoin took off. Right after the collapse that we had in late October, Bitcoin took off and only went higher with the ETF expectation and the big movement, especially now with halving of the Bitcoin coming. Halving is an event where the transaction cost effectively more in terms of the crypto in transaction costs come down and there's more liquidity. At the end, the number of coins, of course, is fixed that the world can mine on. And it's not that you will make more coins, but it's just that after the halving, what will end up happening is there'll be more ease of getting in and buying up these cryptos for the broader investors. And now with ETFs, that'll help it. But in any case, that's gone absolutely parabolic. It's been by far the biggest mover. Then comes Nasdaq. And right here is where the divergence came in, right? So till up to this point, they were kind of going together. And after October, Bitcoin took off a lot more than Nasdaq did. Nasdaq did go up, but not with the rate at which Bitcoin took. And then relatively, you can see the others kind of move in a range bound. And you can see that in this 1 year, only two instruments have been negative so far. One is this treasury yield, TLT. So TLT hasn't really gone much. It at one point fell quite a bit. As you can see, this was during when the October 23 bottom happened. That's when we had TLT go close to $80 from a value all the way 100 plus, right? So TLT had dropped a lot, and then from there it has come back, but still overall for the last 1 year, year to date, not year to date, but over last 52 weeks, TLT is actually negative. And then other negative thing that you see is the commodity. So commodities have been flat. TLT has been underperforming. Both have been flat to negative. And then after that is the Russell 2000, the small caps. You can see that the small caps and the dollar are about similar kind of 7% gain, being kind of flattish. And then above that is the emerging market, hasn't gone up much. Emerging markets are very strongly correlated to the commodities. If commodities are not performing well, emerging market doesn't do well. And then the other key reason is we know that China has had a significant property collapse issues that has been very, very hardly hit. And emerging markets is bigly impacted by China. One key standout is in that region, in the Asian region, has been Japan. And it's quite a feat to watch how the Nikkei has absolutely had hit 39,000 back in 1990 and now in 2024. So it took 34 years for it to come back to where it was. And now it just crossed the 39,000. But 34-year duration for an index to go back to where it came from. So that's a whole different situation there. But in any case, gold, as you can notice, is at 11% for the year. And so the top four really is Bitcoin, then NASDAQ, then you have S&P 500, and the fourth one is Dow Jones in the index. Finally, just want to share a little bit about patterns and trends. This is a chart of the QQQ, and it's, in this case, the duration is called weekly. And the weekly chart in here is representing what we call as a cup and handle pattern. Now, I can kind of show you, in a live way to annotate and show you how the cup forms. So I can go here, click on annotate, and I can take the parabola, and I can take 402. I can kind of draw through the 251 bottom, and I can come up to 386. So this roughly is what you can see is kind of a cup shape that is plotted out. And then I have something called a handle. So the handle here is if I draw a line to the tops, and then I can draw this right here. So if you notice how you hold a cup with, with a handle to it, this is the handle that you're holding the cup with, and this is the cup. When you have a cup and handle pattern and then a breakout above it, so this is the breakout that happened around late of 2023. We broke out above 386, and now we are headed higher. The way you calculate the target, the price, where would, once you have such a breakout, where would it move to, is you take the bottom of the cup, and the bottom of the cup you notice here is 251, and the top of the cup. Now this is a slightly slanted cup. Cups sometimes are symmetric, as in the left-hand side of the brim and the right-hand side of the brim are identical, as in, or very close to each other, like a couple of bucks here and there. So if this was 402 and this was 403, something around that, you would have said that this was being a symmetrical cup. But let me change my headset. So here, the cup is now slightly lower on the right brim versus the left brim, but it is a beautifully shaped cup that is with a handle broken out. And the pattern in between the 386 and the 251 is roughly 135 points, right? So 250 to 386 is about 135 points. So 135 when added to 386 is 486 plus another 30, 516 roughly, or 520 actually. So the place where QQQ is headed over the next few months, you could say is at that target near 520. So if I type in a value here around 520, that's where the calculated cup and handle target would be. Now, will it go in there in a straight line? It does not necessarily do that. Even though this is a cup and handle pattern and that's the eventual target, every once in a while, you will get a pullback because that's how the trend of the markets is. It never goes up in a straight line. So let's look at now, in the very near term, what is the market telling us? So a way to look at that is using momentum indicators. And one such momentum indicator is a famous guy, McClellan is his last name. He invented this McClellan summation index. Go back to Chartschool here, type, not that one, sorry. Here, like I was showing you Bollinger Bands, where you can search stocks and you can do NASI or summation index, and you'll get a full definition of it, how it's calculated. It's all in here, right? But the key is, if I come here and look at how to read this chart is showing me the breadth of the market, as in advancers and decliners. So in this case, NASDAQ being the index, overall, if there are, say, 5,000 or 4,000 stocks in NASDAQ, how many of them are actually going higher versus how many are declining on a day-to-day basis? In this case, I'm showing a weekly. So each candle is the week's decliners and advancers. So net, you can see that it goes anywhere from minus 1,100 to plus 600 roughly, right? That's been the range over the last 3 years, from 2021 to 2024 so far. But the way it moves is it moves in cycles. It comes down, then it goes up. It comes down, then it goes up. It comes down, then it goes up. When the breadth of the market goes up, look at the bottommost panel. And by the way, it follows with the RSI. This is the RSI not of the index, but the RSI of this summation index. Not the QQQ or SPY, but it's the RSI of the summation index. Obviously, you're moving up in the summation index values, so RSI will go up. And obviously, the PPO, the percent, in this case, I've plotted MACD and not the PPO, that will also go up, the moving average, convergent averages. But the bottommost panel is what you watch. The bottommost panel is the QQQ because it's a NASDAQ's proxy. I could have actually not done QQQ. I could actually put the full NASDAQ index because this is not just for the top 100 stocks, but for the entire NASDAQ. So I can actually type in here the COMPQ, which is the full NASDAQ index. So now let me show you here. So notice that when the red set of red sequence of candles come in, as in the summation index of the market breadth is coming down, look at the duration. So let me show. So look at from 484 to 1009 is where QQQ came from this level all the way down. Now, as it's going up, QQQ will start going up. It comes down, QQQ will come down. So every time you have these down cycles, it happens, and you can count them, the number of candles, 1, 2, 3, 4, 5, 6, 7, 8. 8 to 10 of these candles will be on a down cycle, and then the next up cycle can continue where there'll be a little bit of a pullback, but then overall this can go on for, say, another 12 weeks or 10 to 12 weeks. But overall, you notice that from October of bottom, that when the market bottom and the big move we got, we had 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 consecutive weeks of an upcycle. And then towards late December, we topped out on that summation index. That means the market breadth has been deteriorating in NASDAQ over the last month and a half, yet
QQQ or NASDAQ as an index is going higher, powered by those big Microsofts, NVIDIAs, and so on. However, we are at the point when you notice that when the MACD of that summation index begins to cross over and these are beautiful bell-shaped curve, for the next few weeks, like the 1, 2, 3, 4, 5 weeks, you will start getting a decline in the market, and then the bell-shaped curve will start turning higher. And as the bell shape start turning higher, the market will also start turning higher. As the bell shape turns higher, the market will also start turning higher. So we are in the point where we're about to cross on that MACD line. The histogram is about to dip below the zero line and kind of plot out kind of a call it a histogram, or call it a bell-shaped curve from below the zero and then turn back up. So as that happens, you can expect the NASDAQ index to start pulling back. And as that pullback comes, you will see that thing. So it's over the next 4 or 5 weeks. Typically, seasonally, March is a weak period of the market. So it coincides quite nicely with where we are headed. The next 4 to 5 weeks, you can expect this histogram to go down while the prices come down, and then it curves back up higher is when we will start the next move up leg in the NASDAQ. So that's kind of the broad trend. And in a similar way, you can look at the S&P 500. Like the summation index in the S&P 500, you have a pattern, a breadth indicator called BPSPX, stands for bullish% of the S&P 500 stocks that have a bullish looking chart in a point and figure chart pattern. And they're also similar idea that you can see that there'll be a sequence of red candles and sequence of white. So it's like a cycle of up and down in the market breadth. And as the cycles of up and down happen, in this case, on the bottommost chart, I'm not showing QQQ, but I'm showing S&P. You'll notice that during the down cycle, S&P comes down. During this down cycle, S&P will come down. So right now, as the down cycle is about to begin, in fact, you can notice that for S&P, the MACD is already dipped below the zero line. We got the first small sliver of that blue dot below the zero line. You will see how beautifully, and that's what amazes me, is how beautiful bell-shaped it forms, right? So you will see a symmetric bell shape up with it going deeper and deeper below the zero line for the next few weeks. And you can bet as that happens, you will see an S&P 500 start coming down as the bell-shaped MACD plots out below the zero. So that's where we overall are looking. We will, of course, monitor the market, see how it moves over the next several weeks.